All right, it's 8 o'clock. Good morning. This is let's come to order. It's the Bloomfield Township Joint Investment Review with the Board of Trustees, the Financial Sustainability Committee, and the Retired Employees Healthcare Benefits Trust. Let's begin with the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. We'll begin with attendance from the Board of Trustees. All members are present except for Clerk Martin Brook. From the Financial Sustainability Committee, we have Township Finance Director Jason Tice, FSC Chair David Petoskey, Mr. David Olson, and Ms. Rena Emmons. And from the Retired Employees Healthcare Benefits Trust, also Finance Director Tice, myself, and Trustee Chris Kolinsky. Since this is a joint meeting of three boards, we typically entertain a motion for an appointment of a meeting chair. So I will open the floor for a motion.
So moved.
What are you moving?
I'll appoint Michael.
I'm appointing Michael.
Okay.
Because I think
a motion?
That's a given.
Michael
Schostak.
Support.
And a support. All those in favor?
Aye.
Opposed? Okay, that passes. Thank you. At this point, since this is a public meeting subject to the Open Meetings Act, we open the floor for public comment. Residents or other members of the public have 3 minutes to address the boards. Seeing none, I'll close the public comment and move forward on the agenda. Number 5, we're going to approve the minutes of the October 31st, 2024 Financial Sustainability Committee meeting. So for members of the FSC, do I have a motion to approve?
So moved.
Second. Support.
Okay, a motion by Trustee Barnett, a support by Supervisor McCready. All those in favor?
Aye.
Opposed? Okay, thank you. That passes. Next, approve the minutes of the October 31st, 2024 Retired Employee Healthcare Benefits Trust minutes. From a member of that committee, do I have a motion to approve?
So moved.
Moved by Trustee Kolinsky. Support by Finance Director Tice. Those in favor say aye.
Aye.
Opposed? Okay, that carries. Thank you. All right, we're moving on to the meat of today's meeting, which is our annual portfolio review. And just for new members of the committees and for those watching, this is something that we do annually to allow the Board of Trustees to review in their fiduciary capacity the township's funds and investments. And they do so with the advisory committee, the Financial Sustainability Committee, who now in its 10th year was formed to advise the board on matters relating to the defined benefit pension plan. And then the Retired Employees Healthcare Benefits Trust, myself and my two co-trustees oversee the investments for the Retiree Healthcare Plan Trust. So the purpose of this meeting is to hear from our investment advisors, go over our portfolios, and ask any questions so that we are all, as board members, fulfilling our fiduciary duty. So we'll begin with the operating reserves, which is me. In your packet, you have my quarterly treasury report, which outlines the different funds that the treasurer manages. Up in the blue section are the operating funds. These are the township's funds, the reserves and the active funds that we use to pay our bills, meet our obligations, et cetera. So this money belongs to the township. Our checking account, accounts held at JP Morgan Chase, we have a $2 million peg. And so it'll fluctuate right around that amount on a daily basis. But as of December 31st, we had just under $2.8 million in cash in our checking accounts. From there, and this is in order of less liquidity and more return, ideally. So checking accounts, obviously the most liquid funds that we have. That's what we write our checks off of. That's what we make our ACH payments on and pay our bills as they come due. Next, we have money market funds. These are funds that have government securities, treasury bills, et cetera, also highly liquid, but generate a return. Checking accounts don't generate a return. We have 3 money market accounts, one with JP Morgan Chase that we use as a sweep from our checking account. So we have that $2 million peg. Anything above that $2 million on a daily basis gets swept into our money market. We also have money markets at Fifth Third and Huntington as part of our bond portfolios. On average, our money markets are yielding 4.3%, and we have about $18 million in the money markets. From there, again, less liquid, but more yield. We have a bank certificate of deposit that's currently yielding 5.125%, 5 1/8, and we have a little over $5.2 million there. That is a CD, so in a traditional sense, it's a fixed investment for a time period. It was a 12-month CD. It's coming due in March, and so when that turns over, whether it stays as a CD or moves somewhere else, I would expect that the yield will come down on that. Then we participate in 2 local government investment pools. One is through Oakland County. The other is through Michigan Class. And that is also pretty liquid. Think of it like a money market, except that these pools invest in more than just government bonds. They invest in commercial paper. They invest in municipal bonds, things that can generate a little bit higher yield. And so it does. So our local government investment pools yield about 4.6%. So that's a 30 basis point increase over the traditional money market funds. And we have $27.5 million in there. Finally, we have 2 portfolios of bonds. These are government and agency bonds that are yielding anywhere from 3.7 to 4.7%. And they generate $1.9 million in annual income. So that's interest off of the coupon payments. And that's locked in and fixed. And we have the most money there. So it's again, the least liquid, but it's generating some of the highest yields. Of course, it's still liquid if we absolutely needed it because it's government securities. We can sell those, not a problem. But so we have a little over $44 million there. You see that we generated $619,000 in interest for the quarter. And for the year, we are going to finish well over our budget for interest. So that is a quick walkthrough of our operating funds, our operating reserves. I'll open up to any questions at this time as it pertains to the operating funds.
I have questions regarding the operating funds. Sure. I believe the enterprise fund money should be separated out. So should the capital improvement fund. That dramatically impacts our budget. Based on the numbers here, over $500,000 in revenue for water and sewer was foregone and moved into the general fund. I also feel that since the board approves water and sewer rates and fund reserves based on a need for water and sewer to have the cash available, that money belongs to water and sewer. I also confirmed with the Department of Treasury for the state of Michigan that that's their policy and that's the way they follow it. They also cited a 1985 Court of Appeals in Grand Rapids Public Schools versus the City of Grand Rapids, 146 Michigan, APP 652. Interest on public funds designated for a specific purpose follows those funds, and that's what their statement is. Our community is not very happy with our water and sewer rates, and that would probably help keep fees the same for 1 year if it's credited to water and sewer. Capital improvement, I don't have any issue with it, but that's not operating cash. The way we structured that fund, it was only for capital improvements, not for operations. There's no problem with using the investment income to pay for capital improvements, but that does impact the budget and where the money, how the money is being utilized by the township. It also provides us with opportunity to look at the investment generated from the capital improvement funds to pay for long-term projects. If we're going to construct a new facility for the police department, understanding how much is generated by that fund would help manage the money, I believe. The AAA bond rating also provides us with very low interest expense. And based on the rates that you are getting, that provides an opportunity for arbitrage. So why wouldn't we want to utilize that to benefit our residents?
Thank you for the question. I think what you're speaking to relates to the accounting and how the interest is tracked, which I think is a separate conversation from the investment of the funds. I believe that we will be addressing those topics at Monday night's board meeting. And so I'm happy to continue the conversation there, where we can speak more specifically about, I'll need time to look at the case that you're referencing and gather that information. And we've also asked our township attorney to prepare a legal opinion on the issues that you raised. So I would respectfully ask that we can postpone that conversation to Monday as it relates to accounting and how we treat those funds from a management perspective. But in terms of the investments themselves and how those are invested, I think we would still discuss them in a collective aggregate sense in terms of how that cash is invested between local government investment pools, bonds, et cetera. So that's really what we're here more to discuss. But I take the points that you raise and I request that we continue that on Monday. And your other question about arbitrage, I believe we can't issue debt simply for the purpose of investing it.
I wasn't mentioning to release debt to invest it, but if we are generating on the capital improvement funds more than what we're currently paying out, we had recent bond issues, we're below 4%, and if we're allowed to take on debt to build a police facility, and you're generating over 4%, that's a benefit for the township. And if we can do that, why wouldn't we?
Well, Mark, I think our first step on the police, and we need a new fire station, is we've gone to our state and federal officials asking for assistance. Okay. So before we entertain any type of a debt or a millage, which I'm not in favor of, is I want to see if we can get some support from our state and federal allies. So
which is fantastic, yeah. And which is great, but there are other opportunities that Treasurer Schostak can hopefully utilize to benefit the township. And
I think those are great conversations for us to have. I'm concerned as the supervisor of trying to go out for a millage on any kind of new building. I think our residents are pretty exhausted on millages right now.
I would tend to agree with that.
Yeah, so I think the long-term approach as our millages that expire towards the end of 2030 is kind of more of what I see as setting our goal towards. Okay. And if we can get some funding along the way to help pay for that, obviously that's a better picture, but we don't know if we can get anything. But just so you understand kind of our process, or my process in my mind is, let's go get some funding, see if we can get some help, because we've never received anything that I'm aware of from the state or federal government and in the support of capital improvements or roads on roads, yes, on an annual basis, very small, but not for what we need for our communities.
The other thing I'd like to note is the defined benefit. Unfortunately, some of these subcategories are fully funded. Well, fortunately for us, they are. And I don't believe having Cable Studio, which is over 150, maybe 200% funded now, having the same strategy for that group for OPEB debt makes sense as public safety or the general fund. I would prefer to have an opportunity to have less risky assets. Same with water and sewer. It's fully funded according to the information on the township board. And when you consolidate and report to the state, if there's a drop in the market, those fully funded sections and building inspection as well, that's 10% of the fund. Having a different policy which would help alleviate some of the stress and downturns of the market and the reporting, I think that would be beneficial too. But that's not an all-in-one policy. And during the meetings where we were told that the sub-accounts would be reported separate on an accounting procedure, and that hasn't been done here either.
Isn't his question more directed towards a policy review when we go through that later?
No, not, yes, partly. Mark, we do have the separate accounting by sub-account. I believe it's in Brian's green book. Do you have that updated for the last quarter? Well, we could get to that when that topic comes up, when Brian talks about it, but we are absolutely tracking it by sub-account.
So, but there's two parts. We have a report to the board, and is the report consistent to what was agreed to in the past? And how does this report help us make decisions on the budget and on spending? Without this data, especially at the fund level, how do we know that as trustees and the public know that we're making good decisions? So, but those are
well, okay, but again, the retiree healthcare trust, we're not spending that money, so there's no decision around spending it. We're simply putting that money away, saving it, letting it earn a return, so that 5 to 10 years from now, we can start to transfer some of the expenses of the retiree healthcare to be paid for out of the trust. Right now, we're paying the expenses for the retiree healthcare out of our operating budget, and we're simply just putting money away into the trust. So, again, I'd like to keep the meeting moving, and we can address those questions around, again, the accounting of the RHC trust. When that topic comes up, we can address it either when Brian's talking or when the policy comes up. But right now, I'd like to focus on what this meeting has traditionally been focused on, which is the investments themselves, not the accounting of it. So unless there are any other questions or comments, I'd like to move on to the next item, which is the portfolio review for the pension plan trust. And that is going to be led or presented by Brian Green, our investment advisor from Mariner Institutional.
Good morning. Nice to see that Adobe is as aggressive with its pop-ups as every other software provider. So I'm going to walk through everything from a defined benefit standpoint. So this, if you're looking at hard copy, it's the Bloomfield Township DB book. And if I could have you open it to page 2. So page 2 is the mountain chart. So I always think this is a great way to start off because right, this is a long-term pool of assets. You know, Michael had commented on the retiree healthcare trust. You know, have made some recent changes from an asset allocation standpoint because we have a 15, 20, if not longer runway in terms of a plan before those assets are needed to be spent. So that time horizon, you know, is significant. Defined benefits a little different. It's still a very, very long-term time horizon, right? There can be an employee in here that's in there. And I recognize portions are closed, but they're going to be an employee in their late 30s. 50, 60-year time horizon for that individual, right? So while the time horizons for DB and retiree healthcare are a little different, just in terms of DB and its maturity and retiree healthcare, you know, to say this is a long-term investment pool, like someone will be here after me talking about the investments because I will have retired long before the last person gets paid out of this, right? That's 60 years from now. But the township made a decision, and I was actually just looking back through, was one of 25 or 26 communities that took advantage of legislation that allowed a bond issuance in 2013. So that allowed significant, increase in funding, but we traded 80-some million dollars in unknown liability for a certain liability with that bond issuance. So for me, if I'm going to look at one page in this report to say, has that decision been successful? This is the one. And I'm going to have you make it simple. Focus on the bottom right-hand corner, right? Mr. Untitled, you talked about arbitrage, right? So that was an arbitrage decision. We're going to take on debt at a given interest rate in exchange for what can we make in the markets. So, those bond proceeds were invested in U.S. equities and international equities and real estate and private equity and, as of late, real estate debt. And over the last, almost 10 years now, April of 14 through the end of 2024, that portfolio has generated an 8.37% return. So was it the right decision? Yes. Was it a successful decision? Yes.
Especially since our debt now that we're paying on that is only 2% because we refunded those bonds in 2020.
No, that was a real proactive move by the board at the time.
And I'd also just say that,
Yeah.
to clarify a comment I made earlier in response to Mark's question, that legislation was very specific to pension plans.
Yes.
So we couldn't do this. We couldn't say, hey, this worked out so well, let's borrow some money at our low interest rate of 3% and go into the market and make 8% for our operating budget.
Correct.
We can't do that.
Yeah, they were
It was very specific to pension plans.
limited to communities with specific, credit ratings or above. You had to close your system. There were a number of provisions put in place to allow that issuance to happen, which is why there was only, I was just looking, it was either 26 or 28 communities that took advantage of it. Most of them, interestingly enough, within the boundaries of Oakland County. So I always like to start with this and finish with this. It's been a success, okay? Page 3, just talking about overall market results. We now have back-to-back years of a mid-20% return out of the S&P 500. It's my obligation as a fiduciary to this system to temper expectations. I can't recall in the history of the capital markets where it was a three-peat. And I just learned that the Chiefs licensed the term three-peat from the NBA because they copyrighted it. So if the Chiefs win, they can now use the term three-peat. So take that for your random non-investment knowledge from today's presentation. But what's interesting is, that 25% return for the S&P 500, if we instead talked about the S&P 493, so kick out the Magnificent Seven, that 25% return becomes 16. So again, the NVIDIA, Apple, Tesla, Metas of the world just continue to drive, and that was the big driver of returns. So semiconductors over and over and over again, and everything AI continues to be the driving force. I was chatting a little bit beforehand, a little bit of market volatility here in 2025. S&P's up 2.5% through yesterday. But the name that's obviously been in the news the most with, new AI models coming out is NVIDIA. So I had a client call the day NVIDIA was down 17 and change, what do we do? Should we be selling? What should we? And I said, every time something happens in the near term, zoom out. So this is, as of last night, year to date, NVIDIA is down 11.6%. So still feeling the wrath of DeepSync. In the last year, NVIDIA is up 79%. In the last 5 years, NVIDIA is up 1,828%. So yes, it's down 12% in the last, month and a couple of days. But every time you zoom out, okay, we're down 12% in the last month. We're up 80% in the last year, and we're up 1,800% in the last 5 years. So it's amazing, even despite some near-term weakness, just how strong and dominant that stock has been. So how did DB fare? Flip ahead to page 6. I know I've been in front of this group before, and I've said I've always tried to come up with a story And I don't have a good one other than semiconductors, right? Literally, as we walk down the line, it is semiconductor exposure or a lack thereof that is the driver of outperformance or underperformance. So for the quarter, the overall DB portfolio was in negative territory, down 1.2%, in line with its benchmark that was down 1.2% for that same time period. On a fiscal year-to-date basis, so 9 months into the fiscal year, so this would be April 1 to present, because the township's fiscal year end is March 31st. You can see up 4 and change, lagging its benchmark that's up a little over 6%. And in the last year, which would be calendar year 2024, made it into double digits, up 10.8%, but lagged the overall index for the DB portfolio that was up 13 and change. Biggest driver of that underperformance is Edgewood, which we'll talk about in just a second. So on a manager by manager basis, I'm going to sound like a broken record because I'm going to toss out semiconductor names literally as we work our way down. Ancora outperformed because of Broadcom, which is labeled as the poor man's NVIDIA. Fidelity, no surprise, with that 500 index fund right in line. Edgewood underperformed because they were underweight NVIDIA and didn't own Apple. Clarkston underperformed because of Clarivate, which is it's essentially a software for higher ed and medical studies to be able to aggregate and sequence DNA and just aggregate data together, and is a huge user of AI, and that stock's traded off during the year. Reinhardt underperformed for the quarter because of Axcelis, which is about $1 billion chip manufacturer, right? Input into the supply chain. Fidelity extended market, no surprise. Before we change pages, so we talk a lot about diversification, right? We have large cap, mid cap, small cap stocks in the US. We have international equity that's in developed markets and emerging markets. We have, a real estate manager that focuses on higher quality properties. We have a real estate manager that focuses on properties that need development. We have a real estate debt manager that's a way of playing in the market, but rather than buying the building, they're providing short-term financing for a purchaser that wants to acquire an apartment building or a strip mall or things like that. We've added a private equity portfolio that hasn't reported yet, but when we get the December 31st statement, it's going to show a 25% gain right out of the gate. So we'll help improve some of these numbers. So I mentioned we have a lot of diversification from a style and different parts of the market standpoint. We also have diversification from a manager standpoint. So for example, in the small cap part of the portfolio, on the bottom of page 6, we have Clarkston, we have Reinhardt Partners, and we have the Fidelity Extended Market Index Fund. So Clarkston is a Rochester Hills-based manager, 22, 23 stocks in the portfolio right now, has lagged significantly in the last year. They are about 6% of the portfolio. They've been reduced down to that. Earlier in 2024, actually, December of last year, December of 23, we added Reinhardt as a complement. So Reinhardt is a Mequon, so Milwaukee suburb-based small mid-cap manager. So fishing in the same pond as Clarkston, but doing it in a different way. So great from a diversification standpoint. The idea being if one underperforms, the other outperforms. Well, if you look, for example, in the last year, Clarkston's up 4.7 versus their benchmark that's up 12. Reinhardt is up 16.5 versus their benchmark that's up 12. Those two combined, so if we just had an active small cap manager line, the return in the last year for those two portfolios combined would be 11.6% versus benchmark up 12. To me, that changes the story significantly from the standpoint of we have these managers from a diversification standpoint. They outperform at different times and they underperform at different times. If they outperformed at the same time, there's no diversification benefit. Why have two strategies? If they underperform at the same time, there's no diversification benefit. Why have different strategies? But the two of these combined together, and because Reinhardt is 9% of the portfolio and Clarkston is 6%, that's how 4.7 plus 16, the combination of those two becomes 11, not something smaller than that. The overall active small cap portfolio in the last year was essentially a push. flip ahead to page 7. I'm going to break from tradition. Oakmark's underperformance isn't because of semiconductors, it's actually because of Bayer. German chemical manufacturer lost a significant lawsuit around PCB contamination in Washington Supreme Court, which causes that stock to trade off. Fidelity International Index Fund, no surprises. JP Morgan, I'm going to go back on script. Taiwan Semiconductor, didn't own enough of it. It is 10% of the emerging market index, and they were underweight that position. And that stock, in the face of continued, explosion of AI use and development, has continued to rally like you've seen with ASML in Europe and NVIDIA here in the US. Shifting a bit of good news, no report yet out of TerraCap. I would actually expect positive news, just given fourth quarter was the first time in 9 quarters where we saw positive returns out of commercial real estate. So commercial real estate markets seem to be unthawing, starting to see obviously positive income out of those portfolios, but Q4 of 2024 was the first time in 9 quarters where we actually saw positive price appreciation. Now it was like 0.2%, so no one's doing cartwheels down the hallway, but in terms of reversing that trend of the impact of a rate increase in calendar year 22, having a lagging effect on commercial real estate prices, now that that kind of has worked its way through the belly of the snake, we're starting to see positive news come out of things from a real estate standpoint. And that's what you'll see, for example, the Principal Enhanced Property Fund, up 1.5% for the quarter versus its benchmark up 1.1. So starting to see real estate as a positive contributor. And then the final piece that I'll leave you with is the Capital Dynamics portfolio. You'll see a minus 5% there. First money went to work in October and November. Just over 1.2, 1.3 million of the 3 million that was called. We don't yet have a December 31st statement for that, which is totally expected, totally normal. That will come in time for the first quarter report. So that portfolio is secondaries. So it is built by purchasing existing interest in private equity funds at a discount to their current value. So right now, that 1.3 million, I, for example, have the September statement that we just got that shows a value of just over $300,000. So that 1.2 was actually worth more like 1.5. That's a 25% write-up right out of the gate that we would show once we get the December 31st statement. So what I'll leave you with is the efforts to diversify, adding real estate has been starting to be a positive contributor. Once we get numbers in from Bloomfield Capital, that's a positive contributor. The Capital Dynamics private equity portfolio will be a significant positive contributor. So the steps we've taken as a group over the course of calendar year 24, working a lot with the treasurer to find other sources for return besides I need the stock market to go up today and tomorrow and the day after that, are proving to be beneficial for the system. Questions?
Yeah, Brian, the market has been really strong now for I don't know how many years, and like you said, the big 7 driving the S&P 500, and we're seeing the benefits of that with the 8.5% almost returns. When do you start to look at it more and take a more conservative approach? Because we've really experienced some large gains on some particular stocks, and ones you had highlighted. But when do you start ever taking a turn to be more conservative with these investments to protect the equity and the growth that we've received to date? Or do you continue down a path of riding these, the ones we're talking about through the S&P 500 and the top 7?
So first, zoom out a bit, right? Here we're talking about 113, 114 million in market value. This is the equity side of the defined benefit fund. There's close to that same amount that's in the guaranteed account at Empower. So in terms of, you think about the overall retirement system, it's about a 50-50 split between risk assets and non-risk assets. If I think of neighboring communities, at varying levels, a lot of them are a 70-30 mix, maybe a 60-40 mix. So by nature of the the structure of the retirement system already, you're already more conservatively invested than your peers because of that guaranteed account. I don't know what that paid in 2024, 3-ish.
Yeah, it was high three, like 3.8, and for 2025, it's going to pay 4%.
So broad, high quality fixed income, right? Your peers that don't have that guaranteed account, that 30% in conservative assets or 40% in conservative assets is going to be in high quality U.S. fixed income. Last year, that would have returned 1.2%. So all else being equal, I would expect you to have outperformed your peers in 2024 because of the structure of the DB system, because the guaranteed account paid 3.8 versus 1.5%, right? If we had an active manager that outperformed last year in U.S. fixed income, let's be bold and say they did a really great job and it was 2%, that's half the return that the township got out of the guaranteed account. So last year, I would say would be beneficial. But to come back to your question, from a 30,000 foot view, pretty conservatively invested compared to peers. But specific to this is why we're adding private equity and private debt and looking at other options in that space, because we're trying to pull back from just needing the Magnificent Seven to keep being the Magnificent Seven.
I would just add to that, I forgot to mention about the guaranteed deposit account before you spoke. It was in my notes and I didn't look at them. So Empower holds a account that is roughly 50, as Brian said, a little less than 50% of our total assets in the pension plan. It's about $117 million. That account is what pays the pension benefits. Mm-hmm. So that account is going down as we draw money to pay the benefits, and it's earning 4% this year. And then the other half of the portfolio is this, which used to be called the equities portfolio when it was all equities, but now we have diversified it so much that I just call it kind of like the discretionary investments that we have control over. We don't have control over that 50% at Empower. We do have control over these. And so, again, this money is not meant to be used to meet obligations in the near term. This money is used to meet obligations in the long term. Because the money that's sitting in Empower is used to pay the current benefits. So, the best we can do is diversify. We've got international, as Brian said, we've got large cap value, large cap growth, small and mid. So it's, plus the private equity that we got into, plus the real estate, it's a pretty diversified group.
And for Mike, this, I think going back 10 years, their goal is growth. And this would all meet that objective based on the investment policy statement with what's in the guaranteed amount. And then what you've had to draw over the years has been, some pressure and call it conservative to fund the DB when it needed to be funded. And I think, was it Prudential at the time or still is?
It was Prudential, yeah.
Yeah, it allowed us to not have to be forced to sell at times. So it's been a good working relationship over the years.
Yeah, I mean, we've had to draw down. Now this is net, because for example, if you look, I'm back on page 2. I'm gonna get super technical, but if you look at the squiggly gray line at the bottom, the general trend is down. The net cash flow out of this, which would be transferred to the guaranteed account, there's been a net $34.1 million that's been pulled out of the discretionary portfolio to go to the DB. Now, obviously, a lot of that was heavy in, 15, 16, and 17. But for example, here in calendar year 24, cash flow has actually been net positive. We haven't had to meet any MIFL payments to the guaranteed account. So we've been able to invest more on this side. But the general trend over the last 10 years has been drawing gains out of this portfolio to fund the guaranteed account to make sure that those benefit payments, those benefit promises can be made.
The reason that we had to make those payments was because at the time, the guaranteed deposit account was not yielding 4%. It was yielding 0.5% or 1%. And our liability was increasing faster than that. Mm-hmm. And so Prudential was actuarially in the negative and forced us to pump money into the guaranteed deposit account to shore that up. And so we had to pull money out of this account. So of the $84 million that we got from the bond sale, 34 of it had to get pumped into that guaranteed deposit account over the last 10 years, but we've made 63 on our investments. So which, comes out to the 8% return, so.
And how are the contributions to the defined benefit allocated? Because on page 2, that appears to have some of those cash inflows in those numbers. And we also made last year a contribution on top of the defined actuarial contribution as well.
Right.
So where would those appear?
That would be in this,
Page 2 graph?
they would be in the net cash flow number. So the $8 million that we put into the plan last year went into this account because we want to have as much of the money as we can in this account where it's generating an 8% return versus in the guaranteed deposit account where it's earning now 4%, but historically much less. So when we fund money into the system every year, it goes into this account.
I noticed on the GASB disclosures that the defined benefit payment goes in typically November, December.
December, yep.
Would it be more beneficial to utilize some of that contribution at points where the Prudential Fund needs money?
We have done that in the past, but right now, because the GDA is yielding 4%,
It's not required.
it's not required.
Okay.
We're overfunded in that account compared to the liability. So right now,
Good to go.
And I would think historically speaking, we got 4% for the next year, but as rates come down, that's going to start ticking back down.
Yes.
And then I wanted to touch back on, I think every time we talk about Edgewood and Oakmark, and you keep talking about, let's pull this back, let's go to a 1,000-foot view, right? So when I do that,
30,000.
I'll go 30,000. I'll go to the end of the page
That way you can't
you've
see the
given me.
numbers.
So the end of the page for the inception for Edgewood is at the 92. They're ranked 92. Our benchmark is 4th.
Yep.
So and I keep looking. So okay, let's zoom it in a little bit. 3 years. Let's zoom it in a little bit more. 1 year. Edgewood and Oakmark have continually missed. And I know we had one bad year, which you've talked about, where if we scrub that out, 21 or 22 or 23.
22. Yeah, 22.
That it changes these numbers. But similar to what we did with Capital, we found another company to diversify that category. Can you go on? Can we talk about why we haven't done that yet?
So Michael and I have a meeting scheduled on Monday
Okay.
with a candidate to replace Oakmark,
Okay.
and a meeting on Tuesday with a candidate to replace JP Morgan from an emerging market standpoint. And we're in ongoing discussions. So there isn't a candidate to replace Edgewood. We're going to consolidate that into the S&P 500
Okay.
because the index, the Russell 1000 Growth Index, everybody's talking about the Magnificent Seven and how concentrated the S&P 500 is. The S&P 500 looks diversified when you look at the concentration in the Russell 1000 Growth Index. Okay. I took some time. This is actually another client that had Edgewood ask the question. They're like, well, show me the top performers in the last 5 years, right? Like, who do I wish I would have had? And I went and I pulled the top 10 best performers in the last 5 years. 5 of those 10, if you looked at them 5 years ago, you wouldn't have hired because they were dead last. And the other 5 had 25% positions in NVIDIA. Like, they were hyper concentrated portfolios that you would have looked and you're like, there's no way I'm taking on that much risk in this type of fund. So it's, I'm not defending Edgewood. I'm just providing a little context around like, well, hey, if we would have had the top 10, one of the top performers, they're either somebody you wouldn't have hired because looking at their track record, you're like, there's no way as a fiduciary I can justify saying this is a good add to the portfolio. Or if they were of interest, there was such a level of concentration in the portfolio that you want to do it with your personal stuff, right? But putting on a fiduciary and investing somebody else's money, it's just not a level of concentration. Like, those are things that you do in your personal brokerage account that you only tell your friends about when you were successful and never ever talk about when it didn't work. So to put a little bow on your question, within the next week, Edgewood will be in the S&P 500 index fund. And to the extent the two candidates that we've presented to Michael for consideration, he finds as compelling as we think they are, Oakmark will be with somebody new and JP Morgan will be with somebody new. Clarkson is the one I'm still going to stand on and say, please be patient. Look, it's little glimmers. They were 3% ahead in December when the markets traded off. You don't necessarily see it, in these results yet, and they're a little bit ahead, so far on a calendar year-to-date basis. But because we have that diversification with Reinhardt and with the index fund, I can be a little bit more patient with that portfolio.
Yeah, and the reason we didn't talk about Clarkson is because we made that diversification with Reinhardt, which I was really happy with.
Yeah.
And again, like you've always said, let's keep pulling that back. When we look at our three-year, 5-year, we're within the mark of where I wanted to be. So again, I can be patient for a year. I can be patient for 2 years, 3 years. That's fine. And again, we have a good relationship with them, and you brought them in. That's the reason I didn't bring them up.
Sure.
So.
And Mike and I met with David Sowerby at Bancora.
Okay.
And, they're doing very well with his strategy, which is the dividend value strategy. He is a partner that does a small and mid cap portfolio.
Okay.
That's been doing very well. So I've asked Brian to do a little more in-depth research on that and come back maybe at our next meeting talking about adding them to further diversify that small and mid cap area. Just because we've had good success with Ancora, very easy to work with, et cetera. So that's an option as well.
No, and I like rewarding money managers that we already have a relationship with that are good track records, right? That's the point.
Yeah.
And I would just add, I've always been impressed with David Sowerby and Ancora. They've done really well for us. We have a good relationship with them, and certainly would look forward to having some more investments with them.
Okay. Brian, do you want to just touch on page 5? Because at this meeting, we will be speaking to the investment policy later in the meeting, and part of that investment policy is setting our parameters for diversification, for our asset allocation. So I always like looking at page 5, and I think it'll help add context for the board members before we get to that conversation later.
Yeah, so the 3 columns that I'd have you focus on are at the bottom here. And that's minimum allocation, target allocation, and maximum allocation. So first, just as a caveat or clarification, we have total fixed income listed in here. There is no fixed income in this portfolio, but it's a placeholder because once a year, we bring in the guaranteed account into the performance calculation because of annual filings required with the state. So that's something to help Jason and his team make sure they comply with that. So that's why that's in here. There isn't, fixed income.
We do have it in our investment policy that this discretionary portfolio can invest, but that's why the target is set at 0.
Yep.
Because we don't, at this time, we don't want it to, but if for whatever reason something happens, existentially, and you come to us and say, you know what, right now would be a good time to pull some money out of the market, we have the ability to put it into fixed income within our policy statement. But the target is set to 0 for that reason.
Yep. So embedded in the investment policy statement that you have later on in the agenda, which is unchanged from prior years, but from a prudent fiduciary standpoint, the auditors in the room, when they're doing their thing, like to see 2025, 2024 rather than 2020, right? And it's important from a fiduciary standpoint if someone wants to come and chuck a hammer at you and say you didn't do what you're supposed to be doing, having a consistent regular review of that policy document helps defend. So one of the tables on page 2 of that policy document spells out the target allocations for each of these asset classes and then the minimum and maximum allocations. And those minimum and maximums are there. We always talk about the investment policy statement is crafted and implemented during a period of calm to be referred to in a time of stress. So we put these minimum and maximums in place to prevent you from falling too in love with an asset class that's done really, really well and falling too far out of love with an asset class. Valentine's Day is coming, so we'll use those analogies. Asset class is doing poorly, that minimum allocation can force you to reinvest back into that asset class. Pretty wide parameters here, but if we get a market extreme to one way or the other, you're going to end up tripping one of those and cause some rebalance activity.
What triggers reallocation for you? Like, I mean, we're at, our target's 35, we're at 38. Like, to me, that doesn't seem like we're that far off.
No.
Do you do it at 5%, or do you do it at certain times? What makes you get closer back to target?
If it were, for me, if it's more than, 15 or 20% above, meaning right on a 35% allocation, if it got to be above 40, that's going to trigger a rebalance. The other thing to keep in mind is right now we're a little bit underweight in real estate because we've made a commitment to Bloomfield Capital that's going to work, and we're underweight in alternatives. We've put 1.2 of 3 million that could go to work in capital dynamics. We also have space that hasn't been committed anywhere yet. And if you think about it, if we said no to alternatives, that money's got to be invested somewhere else. It's going to end up being in this case, it's in U.S. large cap. Or we've said yes to alternatives. We've made a commitment of $3 million to capital dynamics. Rather than that $3 million sitting in cash, waiting for them to call it to put to work, it's invested in working in the rest of the portfolio. We just work with that manager on a quarterly basis of, hey, where are you for capital calls for the next 12 months so that we don't have a surprise? We have a good estimate, working estimate of when they're going to need money to put to work, so that if a contribution's coming in or a manager has made a distribution, look, we know there's going to be a capital call in 2 weeks. Rather than putting that into the S&P 500, just hold that in cash because we've got a near-term obligation coming.
And so as Brian said, we have a $3 million commitment to capital dynamics. They've called 1.2, so we're waiting for the other 1.8 to get called, and I think they have a year or two to do that.
2 years.
2 years. Typically, it doesn't take that long, but that could come. And then we have another roughly 3 million or 2 to 3 million that we could put to work. I've met with a couple of different fund advisors. Brian and his team are working on some additional ones to give us some options for that 3 million. So it has not yet been allocated, which is why you're seeing that in other aspects of the portfolio rather than, as Brian said, just sitting in cash. Given where we're at, Brian, are there any recommendations that you have of adjusting these allocation percentages as we later on today talk about the investment policy? And do you think that we need to adjust these numbers, or what do you think?
I'm comfortable with where things are right now.
Okay.
But please, look, this policy is an annual review. If we think something needs to happen in April, we're going to recommend it in April. If we
Right.
think
And of
November,
course, the board can modify it at any time.
Correct.
But we just, we just annually review it to say that we reviewed it. And so we've had the conversation now with our investment advisor. His recommendation is that no change is necessary to our allocation strategy. And I'm of the same opinion. So anything else on the pension?
No, sir. Appreciate everybody.
Anyone else have questions on the pension portfolio? Okay, so the retiree healthcare portfolio, which is the other book, you'll notice is very similar in its construction. So, Brian, I don't think you need to go through the same detail. If you could just touch on the overall return of the portfolio and the asset allocation.
Sure. I'm actually going to start on page 2. So this is a page that we'll update. So from a historical standpoint, these were 5 separate and distinct trusts. But in April of 24.
We're different accounts, not
different
trusts.
accounts. Yep. So, the 5 different participating entities were in, we had 15 accounts.
Yes.
Consolidated in April of-
Each sub-account had different accounts for the different money managers.
Yep.
So it ended up being like 15 different
So in
accounts that we
April
were
of
tracking.
24, right, once we closed the books on that fiscal year, the assets were consolidated for investment purposes, not for accounting purposes, but for investment purposes. And now on a monthly basis, not only do we get an account statement from Fifth Third saying, here's the $29 million, we also get a secondary statement that says, here's the amount on a monthly basis that can be attributed, that's assigned to building, cable, public safety. So if we're making contributions, they're allocated each of those sub-accounts. That detail will add to this going forward. I apologize, Michael, you asked for that for this one, and I didn't get it into this one. So when we look at this for the March 31st book, you're gonna see, it's gonna look close to this, but you'll see those values broken out so that you can see, okay, here's how much there is for public safety, here's how much there is for cable and so on. If I could take you to page 6. So from an asset allocation standpoint, a little different here. Because this encompasses all of the investment assets, despite the fact that we don't expect to have any draws from this for the next 15, 20 plus years. If you think about it, as an individual investor, if you have a 20 plus year time horizon, it's 100% equities. And I have no need for fixed income if I've got a 20 plus year time horizon. Public Act 314, which is the state law that governs what we can and can't do from an investment standpoint, won't let you get to 100% equities. The maximum you can have from an equity exposure is 70%. Then we can layer in real estate at 10%, alternative investments at 15%. That gets you to 95. So I still have to have cash or fixed income or some type of conservative investment here. So we've essentially put the Retiree Healthcare Trust in a, we've matched the asset allocation to the time horizon and spending needs of the Retiree Healthcare Trust, right? So we've minimized fixed income and we've maximized long-term return-seeking investments here because we have a 20 plus year time horizon. Now, obviously that can be adjusted 5 years from now, 10 years from now as that changes, but where it sits right now, this is where you'll see, the target to fixed income is 10%. And that's kind of the minimum amount we can have to maximize what we have for return generating assets. So this is where it looks a little different from the DB portfolio because the discretionary portfolio is 55, 60% of the assets with the guaranteed account on the other side of it. So that portfolio can be all risk assets. This one can't just because of the way all of the limitations work within state law. Flip you back to page 3. Obviously, returns are going to be a little bit different here at the total fund level. The manager lineup is the same with Ancora and Clarkston and Edgewood and Capital Dynamics and Bloomfield Capital. But you'll see for the quarter, despite positive contributions from some of the large cap U.S. equity managers, it wasn't enough to outweigh what we saw for negative returns out of international equity and out of fixed income. You'll see for the quarter down 0.74% versus the policy index that was down just shy of 0.7 on a fiscal year-to-date basis. So 9 months in, just over a 5.5% return, and for the calendar year, just over a 9% return out of the retiree healthcare portfolio. So I would look and based on the gains we've seen so far this year, I always use this analogy in like late November, early December when we're thinking about the holidays coming. Like, at that point, the S&P was pushing a 30% return. Like, let's not be greedy. Let's just get me to December 31st at these levels. So I use the same comment. Like, if we can be flat from now till March 31st, this will be a positive year from a funding standpoint for the Retiree Healthcare Trust and continue to see that funded ratio inch higher and higher. The last piece that I want to leave you with, I'm going to flip you back to page 2. I think this is powerful. You know what? Sorry, better example. Page 5. Sorry, page 4. Top chart here. 5 years ago, we were celebrating the fact that the Retiree Healthcare Trust had a $13.7 million market value. The Township has kicked in $9.8 million in contributions over the last 5 years. The capital markets have contributed another $5.5 million to put the market value at the end of December at $29.1 million. So in the last 5 years, we've gone from 13 million to 29 million. Township's contributions get credit for 10 of that. Market gets 5.5 of that. powerful to see that growth in assets. Very educational to understand, 2/3 of that's township dollars being kicked in, 1/3 of that's been capital market contribution.
Okay. Any questions for Brian on the retiree healthcare?
Yes, I do.
Okay.
I'm looking at our actuarial report, and we have about 10% of the monies in cable studio, building inspection, and water and sewer from a liability standpoint, but it also makes up a significant portion of the asset classes. Water and sewer is 122% funded as of the most recent report. Building inspection is 228% funded, and cable studio is 176% funded. So why would we have the same policy being utilized in accounts that are significantly appropriately funded as opposed to accounts which are not?
Can I take that? Mm-hmm. So, Mark, that's a good question. My answer is that what you're looking at is a funding level at a snapshot in time. And even though this plan is closed to new members, many of the members are still active employees, continually earning service credit or accruing more liability. The other thing, so the liabilities will continue to grow, okay? The other thing is that, unlike the pension plan, which is arguably more predictable in the benefit level, we don't know where healthcare costs are going to go. And as we've seen over time, the increase in the liability that the actuaries have used related to the cost of healthcare has gone up considerably. And so as those numbers increase, the liabilities will grow faster. So I think what you're asking is, hey, we've got a fully funded water and sewer balance. We've got a fully funded cable balance. Why are we keeping our foot on the gas pedal? Let's pull our foot off and get into some more conservative assets to protect that money, is I think what you're asking. And again, my response would be we need to keep our foot on the gas because we don't know where that liability is going to go in time. And if we pull back on our earnings, we could fall behind as that liability continues to grow. So that's my response. Brian, do you have anything to add to that?
Yeah, so two pieces. To Treasurer Schostak's point, like it is a snapshot in time. The one piece that we see consistently is, right, that valuation is done as a snapshot in time and with assumptions about what's going to happen in the future. And the biggest negative that we see is medical inflation. Because every year it's, hey, medical inflation, and right, it's here's next year, year 2, 3, 4, 5, and it's like next year we expect 7%, and then it goes 6, 5, 4, 3, and 3 into perpetuity. So that was last year's valuation. And then this year, the actuary comes in and says, hey, so here's our trend for medical inflation, and it's 7, 6, 5, 4. And it's like, well, wait a second. If I looked at last year's versus this year's, this year should have been 6, and you just told me it was 7. And that trend has happened again and again and again. The other piece is I would assume, and I have not looked at the valuation, but as an overfunded system, that overfunding from an actuarial standpoint is being spent down, right? That overfunding is used as a credit to offset normal cost. So that would benefit each of those component units, because if you're 200% funded, the actuary says, hey, we're going to amortize that overfunding over a period of time, say 10 years. So, 10% per year of that overfunded can be used towards any contribution that you have to make, which would effectively nullify the need for a contribution for that unit towards normal cost, right? A normal cost is, right, if I'm a cable employee, I'm earning retiree healthcare benefit this year. Normal cost is what I have to put in this year to pay for it. I'm 44, right? So if I can retire at 65, it's when I have to make your premium payment in 2045 when you retire. Here's how much money you have to put away today to make that. So from an overfunded standpoint, it is benefiting each component unit with respect to reducing the required contribution or eliminating it.
The only thing I would add is that when you say you, it's really the township.
Correct.
The township has to make the normal cost every year of that benefit. But because these particular components are overfunded, we don't have to make a contribution. And so that saves the water and sewer department from not having to make that contribution. That helps the building inspection fund from not having to make that contribution. So the money that we put in from the township level will only be going into the fire, police, and general employee category. And so that overfunding will help over time. Will come down over time. So hopefully that gives you some insight as to why I think we should not have a different investment policy for those units.
But water and sewer is still funding. Cable studio is still funding.
They're not funding, not the OPEB trust.
Uh,
They're funding the current benefits that are being paid out of the operating budget, but they're not funding the OPEB trust.
For active employees, it's funding.
No. It's funding for the retirees from those departments because we're
Through the investments.
Well, we're paying for the benefits for the current retirees. We're paying their health care out of our operating budget. It's not coming out of this trust. Like the pension is coming out of the pension trust through the guaranteed deposit account. The retiree health care is being funded out of our operating budget. It's not coming out of the OPEB trust because the OPEB trust can't afford it. So that's why we're putting money in there. So what you're looking at is probably the cost of the current retirees that we are paying out of those departments, but we are not putting any money into the OPEB trust from those departments. Jason, correct me if I'm wrong.
No, that's correct. We haven't funded OPEB contributions into building or cable and since I think 2017, 2018. Every OPEB contribution since then has been from general or from public safety or from water and sewer fund.
there's no, actually we have been. It's in the GASB disclosure. And it's above the actuarially determined amount.
There's been no contributions from those funds.
There has been contributions from water and sewer. It's in the GASB disclosures.
And I said
I've
I included
gotten
water
those
and
from
sewer.
Tom Hayes. I'll send you a copy of
I
that.
think you're confusing actuarial report versus GASB disclosure report.
But that means we paid more in to water and sewer than just the contributions over the last 5 to 8 years. And it's in the GASB disclosure.
I don't think,
It calls
I'll
it out.
restate what I said. I think you're confused between the purpose of an actuarial report and GASB report.
The GASB report calls out the contributions and the benefit payouts, both items. And we were putting in more into water and sewer than just the benefit payouts over a several-year period.
I want to keep this meeting on track. Mark, what you're talking about, again, are not related to the investments, and the purpose of this meeting is to address the investments within these trusts, and we still have one more speaker to address the other plans, so I'd like to move the meeting forward. Why don't we take this offline, and we can address the differences between the actuarial reports and the GASB disclosures, and continue that conversation either on Monday or when we address the water and sewer rates
in March.
in April. So, okay. So with that, any other questions for Brian? Thank you, Brian.
Thanks, Brian.
Okay, moving on to the beige portion of your Treasury report. I call these the participant-directed investment accounts. These are the accounts that we are fiduciaries for, and we provide some investment advice, but ultimately it's the participants themselves that decide how their money is invested. So this is our 401A plan. The 401A plan is where the township puts its retirement contributions for the employees every year. The employees do not contribute to it. It is an employer-only contribution plan. And the employee can, or employee and ex-employee, because there are active members who are, leave service from the township, but who can take their 401 with them. So all members or participants in the 401 plan can direct how they want their money invested. It's our responsibility to provide them options and help them in doing so in their own investment. The 457 plan is an employee-only contribution plan. That's a deferred compensation plan. So that's the employees making voluntary contributions out of pre-tax, out of their paychecks into this retirement account. And again, they manage it. They determine how they want it invested, allocated, et cetera. And finally, the retirement health savings plan. So since we moved away from the defined benefit retiree health care, we now have a retirement health savings plan where employees, they put money and we put money. So it's both contributions each year that, again, they direct how the money's invested, and they can use that money when they retire to spend on medical expenses, which would be like insurance premiums, and it would be exactly like a health savings account. So, but it can only be used in retirement. So, with that, the other thing is that Rob from Schwartz and Company, local firm here in Bloomfield Township, he's also responsible for meeting with our employees, either in groups or one-on-one, to go over their retirement planning. And that's an invaluable service that I think we provide. And I hear great things from our employees about it, that they enjoy meeting with Rob and talking about it. He helps them decide where they want to put their money in their 401s or 457s. And that. So with that, I'll turn it over to Rob and take it from there.
Thank you. Again, Rob Higgins with Schwartz and Company. We serve as investment advisor on 457, 401A, and retirement health savings. And I think in that capacity, work very closely with Michael and Jason throughout the year. They do a great job as co-fiduciaries of this plan. And, we're charged with oversight of other people's money. And in that capacity, and this segues to the main focus of the slides I'll direct your attention to. With these plans, we're paying attention to participant education, so getting out in front of people. And I really see that as my primary role, or our firm's primary role, is helping people, just being a resource to them, directing their accounts, any other financial questions they have. So participant education, I'll highlight some slides for you. We're paying a lot of attention to plan costs. So I'll provide you with an all-in plan cost and benchmark. Fully transparent. I have no problem getting into the weeds with people that have questions on that. And I think it's important that they know what they're paying for as participants in these plans. And then we're paying close attention to performance of the underlying funds that they have that serve as investment options for them within their accounts. And I will say on the front end that I think these plans are firing on all cylinders. So I'll show you some slides that will hopefully prove, good, solid education, very efficient cost structure, and solid performance. And that, that's A+, and that's a big credit to Michael, Jason, and others involved with making decisions on this plan. So I'll get into the material. Michael, you did want to go through all 80 pages one by one, right?
I did, yes.
Sweet. I'm going to pick some
including
select,
the footnotes.
I'll pick some select slides. I'm going to take you into section 2, page 12. There's a couple dashboard pieces right at the front end here. This one in particular, this is a summary of the 457 plan, and I use that as a big target because, as Michael had teed up already, that's an optional.
So, Rob, the page numbers don't.
I'm sorry, it's entirely.
Oh, here, the one that says
fonts.
Plan Insights?
Yeah.
Okay, Plan
Yeah, inside
Insights.
of
It's really
tab 2,
small,
right.
page 12.
Page 12. And I've got some highlighted numbers on the far right column. And the first one is that 11.6 that you see, and that's the average deferral rate for that 457 plan. And again, that's people, in addition to the 401A, which is funded from the township, that's people saying, hey, I'm going to put in money out of my own paycheck above and beyond what's already going in. And that's a healthy clip. I mean, if we look industry average across the 401K landscape, you know, average participant deferrals are right around that 6, 7, 8%. So in other words, the township is taken seriously, maximizing retirement outcomes. You know, participants are invested in that. We hope that education has something to do with that, encouraging that. So, you know, good numbers in that regard. Similar dashboard piece exists behind that on the following pages for the 401A. I won't spend time on those. I did want to draw your attention to page 17. That is a recap of last year's education opportunities. So all told, I met with just shy of 60 people on an individual one-on-one basis. And those meetings are deep. I do our best to meet people where they're at, and just there's no boilerplate to those. Just helping them with investment decisions, cash flow planning as they're approaching retirement. You know, what their spend down looks like, everything under the roof there. So you know, those are good numbers, and we'll continue to be out in front, whether it's group or individuals throughout this year as well. And I did, behind that on pages 18 and following, I just wanted to give the committee a sample in terms of the follow-up that I provide if I do meet with somebody individually. And just to give you an example of what that looks like, again, if you do read through that, I hope you glean from it that it's not boilerplate. I try and, again, drill down and offer some good insight on the back end so people have something to take away from those meetings on an individual basis. Dive into tab 3 and look at the plan assets and cost structures. So page 22 is a roll up. Page 22, rolls up the 457 401A together. So on a combined basis, those two plans, I'm on the lower right portion of the page, 57 million in plan assets. And then I box scored for you inflows and outflows over since the last time we met 12 months ago. And page 23 and 24 have each of those plans split out respectively on an individual basis. Fast forward to page 25, and this is a all-in cost analysis. So cost structure of the plans, there's 3 cost buckets, if you will. It's the underlying weighted average expense ratio of the funds, our annual advisor fee, and then Empower serves as the record keeper. I know they're involved in the DB plan, but separate, they serve as record keeper on the 401A and 457. So I'm on the lower right corner there on page 25, and you'll see a weighted average of 36 basis points, 0.36% of the expense ratios of the funds. Our effective rate, we're on an incrementally declining fee schedule, and currently our effective rate annual basis is 0.17%, 17 basis points. And then Empower's annual record keeping fee of 6 basis points, 0.06%. Adds up to 59 basis points all in cost. So I have no problem telling people, and this comes up a lot if people are asking, hey, should I roll to an IRA, work with an individual advisor, or should I stay in the plan? Well, you're getting economies of scale staying in plan. Sometimes that's a relevant point. So again, all transparent, and that's a good measure, and I'll show you page 26, which is an attempt to benchmark that cost structure. So at the top section, you'll see the Bloomfield Township plans at 57 million, average per participant balance 116,000. And then I pulled 2 data points, benchmarks for $50 million plans and $100 million plans. showing you the average and median scores there. So, the takeaway from this page is we're very cost efficient relative to benchmarks. You got a question?
Yeah, Rob, and when you were talking about fees, just make it clear though, if someone has a 401k, what's their fee usually in an average 401k versus the fee that you and Empower are charging? Just
Actually,
because that's what you were getting at with the.
yeah, so there's the all-in cost structure. I can take you to page 27 where I actually have it built out on a per component basis.
Okay.
So each of those cost structure, or each of those cost components, going left to right in the shaded blue, I went with earth tones on my color scheme. Shaded blue is the Bloomfield Township plan, and so in the middle row you'll see that's a record keeping cost, 0.06, and the average for $50 million plans, record keeping is 15 basis points, and if you go all the way up to $100 million plans, 11. So for that cost component, record keeping, you can see that Empower's extremely lean. How they priced, they were very aggressive in pricing for the township, and that's great. And then I offer those same benchmarks for our fee. Advisor fee, 17 on the current plan structure. Industry average for $50 million plans is 16 basis points. And then 11 for $100 million plans. And again, we're on an incrementally declining fee schedule, so as assets increase, our fee continues to go down.
What is the next benchmark for the fee going down?
This is almost rounding. I know I was kind of expanding out the decimals, and we're just about ready to tick into 16 basis points. I know that. So does this page help address your question?
Yeah, I just want, for the listening audience out there.
This is exciting stuff for them. Yeah, I know.
Well, but the fees are very important.
Yeah, they are.
And your fees are heavily discounted, and you're getting a great return on the investment. So before people start taking their money out of this and maybe put in another 401k they have, look at the fee and look at the return.
I just had a conversation yesterday with somebody that was asking me questions, and I had that exact same point. As long as there's money in the plan, whether they're retired, separated from service, they have access to an advisor, a firm, and if you were to, here's a great example. Someone's got $100,000 in this plan, and their all-in cost is 0.59%. And if you were to lift that $100,000 out and ask a advisor to work with you, they'd say, we'll charge you 1.25% maybe, or 1% on annually, plus the cost of the fund. So all of a sudden you're kind of increasing.
You double,
triple the cost. So I have all those types of conversations just to help people make informed decisions. I'm not incentivized to tell them what to do, but I just lay out the information for them, help them make the best choice for them personally. Yeah.
And just to get back to the fee issue, I know over the years the board has been working with Schwartz and Company, and Schwartz has been very cooperative in making your fees very aggressive as far as being helpful to our employees, and you continue to be. So that's something that I know has been important to you. It's been important to the township for our employees.
Well, it's an important client of ours. I love working with the people here, and the industry is, everyone knows, is competitive too. So if we're not doing our job, Neil, you'll bounce us. I know that. So at page 28, that is the retirement health savings plan. Again, employee funded in addition to employer contributions. It's not record kept by Empower per se, but a company called Avabin. They serve as administrator. And lower right column or corner of the page, you'll see this plan is now 6.6 million. Plan assets started in, or not too long ago, it was well under 3 million in plan assets. So it's had good growth. It's funded aggressively as well. Cost structure for this plan is a little different. Again, a different administrator. Page 29, I'm offering you the all-in cost structure for that plan. we have 11 basis points on the average investment cost. Our fee 17, and then the record keeping fee of 0.56. And last year we hit a break point that was at 0.86. Once we tipped over the $5 million mark, they dropped it to 56 basis points, and then I asked the questions coming into this meeting at 10 million. There's another break point. Again, Township's is an important client to several organizations, so we'll continue to partner with you, and to the extent we can continue to drive down costs. That's our job, is be your advocate as well on those record keeping companies. I offer you similar benchmarks on page 30. I used $5 million and $10 million plans in the universe of benchmarks. So we're still cost efficient. Every plan, a big driver behind plan cost is the average per participant balance. How big is the plan? How many participants? That's a big driver to how these record keeping companies price plans. So there's healthy average per participant balances, which helps Township. And then I did offer a summary of it's not necessarily participant directed, the 529s, we have those. It's college savings plan, payroll, direct. I offer the summary just to be consistent with prior years, but it's kind of a separate beast from the 457, 401A, et cetera. Getting into performance, tab 4, go to pages 34 through 37. This chart shows each of the underlying investments of the 401A, 457, and retirement health savings plan, and it stacks the fund on top of its benchmark category. And I awarded it a blue shade if it matched or beat benchmark in a given time frame. So visually, if you like to see a lot of colors, and some funds are maybe wobbling a little bit, but the bottom line score here is on page 37. When you look at a 10-year average or 10-year number, and 92% of the funds outperforming benchmark, and then mid to high 70s on a 5, 3, 1 year, and that's meaningful because, again, this is participant directed, and so people are investing in these very funds, and these are raw performance scores, and just the optics here, hey, this is a very solid score table. It's not the end all be all, but I like to see these types of numbers because it means the performance of the investment menu is pretty solid. So that's check plus. I offer another way to view performance, pages 38 and 39. Again, these are participant directed. Everyone's account is a little bit different, one versus the other. But on a plan level, going back to 2011, I've just tracked the plan level rate of return each year and stacked that against two benchmarks, one offered by Fidelity for their large market plans, and then one offered by Vanguard. And compare the IRRs to those two benchmarks over time from 2011. And you'll see on the 401A plan, we have an annualized net return 10.12% versus the benchmark's 8. So strong outperformance on the 401A, and that's really nice to see on a plan level. And
just if I could jump in there.
Yeah.
So this was very helpful, this chart, to me, as we've begun negotiations with our labor unions. And of course, the number one thing we hear is we want pensions back. And we talk about the 401A plan, and I pointed them to this, and I said, the average annual return, or the annualized return since we launched this, was in the 10% range. Per year. And so that's a pretty good yield, and it's beating the benchmarks.
Yeah, when you can compound that outperformance year over year, that's driving a really solid outcome long term.
Right.
So we hope to maintain that for sure.
Yeah. So this is a really impressive number.
Yeah. The same type of annualized return is offered on page 39 for the 457. It's a little bit different, you'll notice, and a lot of that comes down to composition of the plan. If you looked in aggregate, the 457 tends to hold a little bit more cash in the guaranteed accounts. So that's a long-term drag on performance. So there's a little variance between what you see in the 401A, 457. I will say, and you can see this back in the dashboard pieces on the education section, there's a high level, a big number of people that are choosing their own funds, so to speak, but we're meeting with them. And instead of just defaulting into a target date fund, we're putting them in custom portfolios. And you know, that risk appropriate. And I think that's helping to drive those long-term numbers. And you know, we got to continue to do our job to make sure we're optimizing their retirement outcome.
So in that regard, Rob, do you have any recommendations as to funds that we should be removing?
Yeah. So the last part of this section here is really our drill down on a fund by fund basis. We're evaluating not just raw performance, but body of work of a fund, risk measures, management tenures, sector composition, et cetera, stacking it against benchmarks. And is this fund doing what it's supposed to be doing? Do we have to put it on watch? Watch doesn't mean bad fund, but is it wiggling a little bit? And we got to pay more attention to it if it doesn't need to be replaced. At this time, I put two funds on watch. They're both in the fixed income. You know, they're not falling off the edge of the cliff. So my tendency is I would never want to have the precedence to change just for change's sake. You know, when you lop off a bad month, add a good month, it can really swing quintile ranks, et cetera. So I always like to pace funds, track them, and then if we can make a very informed decision going forward, if they need to be replaced. So,
Well, so sorry to cut you off. I just want to be mindful of time.
Yep.
And that we've got a few more other items on the agenda, but I noticed on page 78 you have your recommendations.
Yeah.
I don't know if that's where you were going next.
Yep.
Or,
And
you and I have done a deep dive on these funds.
Yes.
But for the sake of the board's time, this is the summary. And of course, the board has all the information here in this book
yeah, and I'm happy
to do your own analysis.
I'm happy to take any questions at any time if you need any further information. But just to bottom line this, on page 78, you know, all those funds that I have on the top half of that page, as expected or better than, from performance, risk, et cetera. A couple on watch, no actionable items. And, you know, so all in all, you know, a good report, and appreciate the time being able to report this to you. Any general questions?
Okay.
Yeah, all right, thanks.
Thanks, Rob.
Thanks, Rob.
And thank you for all the work that you do in meeting with our employees. I hear, as I said, great things about that. And so, and you know, one other thing I wanted to add, so just again, to clarify, the 401A is a plan that all employees that are not pension eligible, right? So anyone hired after 2005 or 2008 in the fire department are eligible for, have this 401A. We open it for them and we put money in every payroll cycle, pre-tax, it's not pre-tax because it's our contribution. And they then can go into the Empower website and, working with Rob, decide how they want to invest that money. And so all employees, again, except for the pension eligible employees, have that. The 457 is a purely voluntary contribution from the employees, but less than half of the employees participate. And so working with Empower on Monday, I believe it was, right, Monday, we sent out a survey to the employees Basically, 7 questions about, hey, you have this 457 benefit. Do you think you're contributing enough? Would you like to contribute more? What's keeping you from contributing? Et cetera, to try to get some feedback as to why people aren't using it. And maybe, again, guide our thinking in terms of how we can address that plan. So, it's got good numbers, right? I think the number was 11.6% or somewhere in there of pre-tax contribution rate from those that participate, but only less than half of the employees actually participate. And then the other thing I want to add is, again, and coming back to what I said before about employees wanting the pension back and that we can't offer them that. So one of the things that I've been working on with Jason and Empower and Rob and Elizabeth is adding a lifetime income option to the 401A plan. So basically what I'm calling the personal pension, so that employees who choose, and it would be purely voluntary, would be able to direct their investment into this product. And we're not sure which product we're going to go with yet. But they would be able to put their money into this product, and when they retire, they would have a pension. And there would be some benefits, like if they if they passed away before all of the funds in their 401A were exhausted, unlike a pension, that money would pass to their heirs. So, Rob, did you want to add anything to that?
Just
and from the limited number, and this is new. Most of the employees don't know about this yet because we're not ready to roll it out. But I wanted to talk about it here, that we are addressing this this desire for a lifetime income plan, and we're putting it within the context of the 401A.
Yeah, I'll give credit to Michael and Jason. They're ahead of the curve here. Industry-wide, these guaranteed income products being eligible for defined contribution plans, it's a newer thing. And so there's a lot of due diligence being done behind the scenes right now, and just trying to make a very informed decision on what that will look like if we go that route for the plan. So we're exploring a lot of different opportunities, meeting with a lot of people, and kicking the tires, so to speak. But they've rolled some products out before, different record keepers, they haven't stuck. So we're looking at portability, all those types of nuances that come with that type of product. And more to come on that for sure.
Yeah.
I just want to comment on that. Thank you very much for looking into that. I've heard the same thing, that a lot of people want those pensions and trying to find different avenues. We have talked in length about how we could do that. And even with the previous treasurer, this was an avenue we wanted to get to. So the fact that we're getting there is exciting. And again, even if our employees don't utilize it, options is what we're trying to give them here. So thinking it through and not just rushing it through to understand that portability, so not stuck into a product or a servicer, is a big deal. So I do appreciate your due diligence.
Yeah. Cool.
Thank you. Okay, so that completes our annual portfolio review. The next item on the agenda is the annual policy review. And as you've gathered so far today, working with our investment advisors, I'm not recommending any changes to these policies, but it is best practice to look at them and ask ourselves, is this serving our stated goal for each type of fund. So the first investment policy is our general investment policy. This governs the application or the investment of our our township operating reserves. Oops, I'm not looking at the right one. General investment policy. It was approved by the board last year, February 12th. And basically, the investment of operating reserves are governed very strictly by Public Act 20 of 1943, which says what we can and cannot invest in and how that works. So basically, this policy says that we will abide by Public Act 20, and that it also includes which depositories we are authorized, I believe, or that was a separate resolution. But it says what our objectives are: safety, diversification, liquidity, standard of prudence, yeah, so unless, are there any questions on the policy? It was in your packet. Anyone who does work for us, like an investment advisor or custodian, has to acknowledge, they have to sign an acknowledgement that they've received and reviewed the investment policy and they agree to comply by it. So Fifth Third and Huntington and everybody, Chase, everyone that does financial work, have a financial role as a fiduciary has to sign that policy. So I'll open it up for any questions on this policy. Okay. And
I have some questions on the, just from a clarity standpoint, the general fund assets or all township fund assets?
All township assets.
Okay. Okay.
Okay. So we'll consider that reviewed. The next policy is the pension plan trust investment policy, and the public act that dictates how we can invest pension money is Act 314 of 1965, and it sets, as Brian said, guardrails as to what we can invest in. You can see those in Section 3, the authorized investments. There's limitations, and that we are basically authorizing the plan to invest according to the law, according to Public Act 314. And then on page 2 of that policy, you see our asset allocation that Brian referred to earlier, the minimum allocation, the target allocation, and the maximum allocation between large cap, small cap equities, international, real estate, alternatives, fixed income, and cash. And again, there's a recommendation not to change these at this time. But of course, I can bring this to, should something change, I can bring it to the board at any time to review and make a change. But at this time, I'm not asking for any changes. So are there any questions on this investment policy? No? Okay. We'll consider that reviewed. The third one is the investment policy for the Retired Employees Healthcare Benefits Trust, again, governed by Public Act 314, same as the pension. So this plan, or the text of this policy is, I don't want to say virtually identical, but very similar to the pension plan policy. The only difference, or the major difference, is the asset allocations. As Brian said, the pension plan has the guaranteed deposit account, which acts as a very large fixed income vehicle. So the allocation of the discretionary funds is a little bit more aggressive. Here in the retiree healthcare fund, we don't have that. So we have an allocation to fixed income, and we've got a little bit more of a conservative approach. So you see here, again, minimum, target, and maximum allocations, all within the law. So are there any questions here? I'm not recommending any changes. And of course, anyone who provides services to the Retiree Healthcare Trust has to sign an acknowledgement and agreement to comply with the policy. Any questions on that? Okay, we'll consider that reviewed. Then there's the participant-directed plans investment policy. Again, this doesn't have specific allocations because we rely on each participant within the plans to decide how they want to allocate. It simply says that we need to provide a broad range of funds for them to choose from, and that we have to monitor those funds' performance and make recommendations for changes. There is a switching cost when we do make a change. So anyone that's invested in a fund that we want to swap out, we have to move them from that fund to the new fund. And so there is some disruption there. So we want to try to be limited in making those changes, but when something happens that we do need to make a change, a fund is significantly underperforming, they've lost their key manager or some other impetus or catalyst that moves us to change funds, we can do that under this policy. So, and again, I'm not recommending any changes to this policy. So are there any questions or comments on that policy? Okay. Seeing none, we'll consider that reviewed. Get to new business now. I've talked to our investment advisors and decided that we should go out to bid on custodial services. So currently, Fifth Third is our custodian for the pension plan and the retiree healthcare plan. This would not affect the defined contribution plan, so the 401 to 457, where Empower is the custodian. We are not talking about changing that. This is simply for the pension plan and the retiree healthcare trust, and also custodian, which we don't currently use for the operating reserves. Right now, the operating reserves are held at both Fifth Third, Chase, and Huntington. I'd like to consolidate that. And since we're doing an RFP anyway, I thought we could get one one bank to help us with that. So I put it in your packet, and hopefully you got a chance to review it. Are there any questions or comments on going out to bid? Obviously, we haven't gone out to bid. I believe it's been 7 or 8 years, right, on custodial services. This is, for the most part, this is kind of a commoditized service. And so I just want to make sure we're getting the best possible combination of cost and service. This is not in any way saying that Fifth Third is doing a bad job. I would encourage them to bid, but I just want to keep them honest and make sure that we're getting the best service and the best cost for our needs. Our plan has grown in the last 8 years. And so 8 years ago, we may not have been interesting to some of the larger banks. We may be approaching that. I don't know, the larger banks like the B of A's or the Chases or things like that. I don't know. We have a relationship with Chase, so I'm going to offer to them to see if they want to bid, but we may be too small for them still. But definitely for the larger middle market banks, we should be attractive, and hopefully we can get some good responses. So I'll open it up for comments or questions on the RFP in your packet.
I think it's a good practice.
I concur.
I've got a question on flexibility.
Okay.
I prefer that you have the flexibility to pick what's best. Sometimes an institution can't do everything that we want.
Mm-hmm.
I would prefer that you have the flexibility to make choices and plan.
Okay.
So sometimes an all-in-one, and sometimes it's best to have an alternative that you can go to when things change unexpectedly. So if you can have that flexibility in however you go out and approach,
Mm-hmm.
I would prefer that.
You mean between the operating reserves versus the pension plan, that kind of thing? Is that what you're talking about?
In general, whether you want, just in general.
Okay.
I think sometimes when you get tied into one facility,
Mm-hmm.
Things change at a different facility, and then you have to wait before you make a change on something that meets all of the government requirements and whatnot. Having that flexibility, I think, would be good for you and good for the
Yeah,
township.
no, absolutely. And in the miscellaneous section on the last page, we reserve the right to reject any or all responses, to accept a response. We want the response that is most favorable to the interests of the township. And so if that means that, we think that ultimately the board will award the contract. So I'm just going out and doing the RFP, but I will bring back my recommendation to the board for approval. And at that point, the recommendation may be, hey, let's do one custodian for the pension and the RHC and one custodian for operations. We have that flexibility.
Okay. Good.
Yep. Okay. Any other thoughts, comments, questions? Okay. Where's my agenda here? That's it. So the last thing, I do want to just amend the attendance record, Tom. I'd like to note that our Township Attorney, Dirk Beckerleg, is here, and our Deputy Treasurer, Mary J. Baharian, is here. I want that noted for the attendance. Okay, so unless there are any final thoughts, comments, or questions, I would look for a motion to adjourn.
So moved.
Support.
We have motion support. All those in favor?
Aye.
Aye. Any opposed? Okay, we are adjourned. Thank you, everyone.